Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, it's been an exciting week. It's been a bit like buses where you wait for one to come along and then two come at once, because last week we had the US election and we had the markets move quite violently where people were betting against technology stocks and government debt. So they were betting heavily that they would fall because of a blue wave that hasn't yet materialised. Technically, we could get a blue wave in January, but that's something to talk about nearer the time. And this week, there's only one story in town, and that's the potential COVID vaccine from Pfizer and BioNTech, which has apparently got a 90% effectiveness. So come Monday, when we all woke up to the news, you can imagine the euphoria around the world, the excitement that finally we may have turned the corner on this pandemic and life might be able to get back to normal. And in fact, depending on which news articles you read, there is a potential for this vaccine to be out and about and being used within the next few months. Will that be obviously have a massive impact on life as we know it, given that we are currently in lockdown? But you can just imagine what that did to investment markets. It literally turned them on their head. So just to give you a bit of a summary, I mean, when the news was announced by Pfizer, the FTSE 100 leapt immediately 5.7%. We're talking about going along and then jumping 5.7% in a matter of seconds. So on Monday, this was reflected across all risk assets around the world. So the FTSE was up 5.7%. The German DAX was up 5.5%. We saw oil rally 8%. Don't forget that oil is a good indicator of economic activity. So if demand is predicted to pick up in the future, then the oil price will likely go up and surge as well. We saw US small cap surge 3.7%, which is more than the wider S&P 500, which rallied 1.5%. Now, the reason for that is obviously if the more economically sensitive small cap stocks, so they are less exposed to overseas, so outside of America, those economies, then they will obviously rally more strongly if the economy can get back to normal. We saw a similar pattern in the UK, for example. So we saw the FTSE 250 rally more than the FTSE 100. And now we see that because, as I say, the economically sensitive stocks for the UK economy tend to be centred around there in that sort of mid to low cap range. And so they rallied strongly because if we get out of lockdown, then finally all these retailers can open. Now, interestingly, if you look at the companies that performed the strongest, British Airways, for example, their share price leapt 25%. Go down the other end of the spectrum, Zoom, who we all now know, go back to before the pandemic. Most people probably didn't know who Zoom was or what it was or had even used it. Well, of course, we all now do Zoom calls, and their share price slumped 18%. And we also saw technology stocks widely sell off. So on the day where the S&P 500 rallied 1.5%, we saw the Nasdaq close down 1.5%. That's a huge dispersion. So basically what we saw are people selling tech stocks quite violently, rotating into economically sensitive areas like financials. We saw the financials surge up to 20% on the day. And the cyclical sectors were very popular. There was a growth to value rotation. You'll hear me talk a lot about rotation now in the coming days and weeks on this particular show. Growth to value rotations were very aggressive. In fact, we saw some of the most aggressive rotations we have in years. And it meant that we saw an aggressive sell-off in momentum plays. So if you think about it, anything that was a winner during the pandemic, the work from home, the stay at home winners, a lot of the technology stocks, a lot of the social media companies, a lot of the online retailers, think about people like Amazon, they suddenly started to sell off as people rotated out of those into the more cyclical sectors, so like finance, for example, or consumer discretionaries. So that rotation was very violent. And we saw the dispersion, so tech did badly. If you move over into bonds, government bonds, developed world government bonds did badly. They sold off because people were moving into equities out of bonds. And the reason they move out of bonds, because if you think about it, bonds do well when the economy does poorly or the outlook isn't so great. So we've been in a cycle for the last 6 to 9 months where, because of the pandemic, the work from home set up, a slowing economy around the world, that has been great for tech stocks, and it's been great for things like US treasuries and gilts. Now we had this ray of light that's going to be a vaccine. Everybody's starting to rotate very aggressively in selling all the things that did well and buying all the things that had underperformed. That's why the FTSE 100, for example, rallied so strongly. It's been a big underperformer year to date versus other geographical markets, for example, US stocks. And things were compounded in China because the Chinese government also launched a crackdown on some of the big tech names over there, so Alibaba and Tencent. So the regulatory crackdown in China added to the headwinds. And we've also seen something similar in Europe this week with Amazon and the European Union. So it's all been very negative for tech stocks. So basically what was working last week after the election were the losers this week. So it was that work from home, COVID portfolio that has done brilliant in the last 6 months were the underperformers, and everything else surged higher. So there's a sense of euphoria around markets. The S&P 500 is pushing towards its all-time highs, hasn't breached that all-time high just yet on the closing basis from September. The same for the Dow Jones. So keep an eye on those highs, because if we break those, that is obviously going to be very, very bullish. If you look at things like gold actually sold off 2% after the news of the vaccine, and that's because obviously gold is a haven play. Any haven play, whether it's bonds, whether it's or government bonds in particular, or gold, sold off on the news. Now the pound also rallied this week, and that's because there was some positive news and enthusiasm surrounding the potential deadlock being broken between the European Union and the UK on the ongoing talks. Of course, that's good for the strength of the pound. So if you take all that together, what you saw this week is if you held tech stocks and you held US treasuries, for example, and gold, they would have been sold off. You would have had a very tough 1 or 2 days in the last couple of days, and that would have been compounded by the rise in the value of the pound. So it would have meant that your overseas valuations would have actually fallen when you take into account the currency exchange rate. But the big question is, has the market got carried away with itself? This rotation has been so strong. As I say, it's one of the strongest momentum to value rotations that we've seen in a very, very long time. And it's all based upon this optimism surrounding the potential vaccine. Now, there are potential other vaccines out there, but the Pfizer vaccine could be imminent. I mean, the government is talking a lot about the NHS and potential rollouts maybe before the end of the year. But there are storage issues with this particular vaccine that has to be kept very cold. So we're not out of the woods yet. There's still hurdles that the vaccine's got to overcome before it be widely used in the UK in particular, but also globally. So what we're seeing now is, after a 2-day excitement rally rotation, that the market's taking pause and considering, well, we are still in the middle of a pandemic. The COVID scenario is getting worse. We're seeing more and more cases in Europe, in America. There is the potential, people are talking about, that Joe Biden is obviously going to come into office in January. If the vaccine hasn't come into use by then and COVID got under control, then he may actually take more stronger action like we've done in the UK of our lockdown. Something we have to see. Of course, that's not going to be good for the economy in the US. On top of that, you've got to bear in mind as well that the US Federal Reserve will be watching the yields that are spiking higher on all of these treasuries. So like I said, with the treasuries falling in value, the yields were spiking, and so that makes the borrowing rates within the economy increase. Basically, the Federal Reserve won't like yields increasing, because all you've got to bear in mind, quite simply, is that if they keep spiking, it may be a headwind for the economic recovery that we're seeing in the US in light of the pandemic. So they don't want it to be snuffed out. And so you may see they step into the market and start buying treasuries again, which of course would then see bonds, treasuries in particular, rise in value if you get a big surge in demand from the US Federal Reserve. So the point is that this has been an exciting week. We've seen two events. We saw the US election last week, we've seen the COVID vaccine this week, and we've seen a complete whipsaw. You'd almost have whiplash if you're trying to chase these trends. We've got to see how they pan out, because for all the enthusiasm and euphoria, we've still got a long way to go. So keep an eye on all of those headlines, keep an eye on all of those assets, see how they move in the next coming days and weeks, particularly in reference to how they moved on Monday when the vaccine was announced, because you obviously might see some return or mean reversion on some of those asset classes. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com. It is the email address. Twitter is money2themasses with the number 2. Don't forget you can find us on Facebook, Instagram, and of course do follow our YouTube channel.